US traders looking for rate cut direction from the Fed chair were disappointed overnight. Australian consumer confidence drops again. And Singapore's inflation is softer than expected. That's coming up in our 5 Things in 5 Minutes on Wednesday, September the 24th. And then, in our deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, analyses China's domestic deflation and what can be done to turn that around.
For large firms, of course, they can make use of their scale in order to reduce the cost, in order to earn some market share. And now the government see this as perhaps a big problem.
But first, in 5 and 5 with ANZ, US markets wavered overnight as traders viewed comments by Federal Reserve Chair Jerome Powell as void of any indication that rates would be cut again in October. The comments came after several other Fed governors laid out a range of views. Here's ANZ economist Bansi Madhavani.
Fed Governor Michelle Bowman said that it is time for the FOMC to act proactively given the deteriorating labour market conditions. She's concerned that if labour market weakens even more, then the FOMC will need to adjust policy at a faster pace and to a larger degree. On the other hand of the spectrum was Chicago Fed President Goolsbee, who said that the FOMC needs to have a cautious approach to monetary policy easing as inflation is running higher than the Fed's target. Atlanta Fed President Bostic also said that the Fed needs to remain concerned about inflation as he believes there is more inflation down the road.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.7% and the Nasdaq down 1%. The 10-year US Treasury yield was down 3 basis points to 4.117%. Gold rose another 1% to $3,812 an ounce. It hit $3,824 overnight. West Texas oil futures rose 1.6% to $63.29 US a barrel. The US dollar index fell 0.1%. The Aussie dollar was flat at 65.98 US cents and the Kiwi down 0.1% at 58.59 US cents. Number 2. ANZ's Roy Morgan Australian Consumer Confidence Survey showed another drop last week. ANZ economist Sophia Angala says household confidence in the economy over the next year led to the fall.
Household confidence in the economy over the next 12 months fell to its lowest level since around the middle of April, which would have been the first survey period which fully captured US tariff announcements. Notably, household confidence in the economy over the next 5 years did improve slightly following the sharp fall in the series in the prior week, but that sub-index is still hovering at around its lowest levels in the past 15 years.
Number 3. Singapore's annual CPI inflation rate continued to undershoot expectations in August. The headline rate of 0.5% was slightly down from July. ANZ Head of Asia Research, Koon Goh, says the big surprise was core inflation at only 0.3% annually.
This is the lowest core inflation reading since February 2021. The key downside surprises were services inflation. This was somewhat surprising as some of the components around household services and recreational services actually came in softer or in some cases actually fell in the month. Overall though, the MAS has maintained overall inflation forecast at 0.5 to 1.5% for 2025, likely coming in at the lower end of that range.
Number 4. Koon says ANZ Research doesn't expect the lower inflation to have implications for the Monetary Authority of Singapore. That's the MAS.
Although inflation has been low, we're expecting inflation to start to pick up over Q4 of this year on the back of less favorable base effects. And we're forecasting inflation to continue to rise or normalize towards its long-term average over the course of 2026. And that's the important marker for monetary policy, which is why we don't anticipate the MAS to ease policy further.
Number 5. Malaysia's annual inflation rate edged up to 1.3% in August, as expected. ANZ economist Arindam Chakraborty says this follows a preemptive rate cut by the central bank in July to support growth and comes ahead of petrol subsidy changes, which will take pressure off prices.
Starting September 30th, the government will lower the price of RON 95 petrol, which is the country's most popular fuel, to 1.99 ringgit per litre for Malaysian citizens, down from 2.05. Foreigners, meanwhile, will pay a floating rate of around 2.6 ringgit per litre. This subsidy reform is expected to save the government between 2.5 and 4 billion ringgit annually. Moreover, the petrol price cut is likely to exert mild downward pressure on inflation over the coming year.
Arindam Chakraborty there. Now, in our deep dive interview, I spoke to ANZ Chief Economist for Greater China Raymond Yeung about China's deflationary pressures, where they're coming from and what can be done about them.
We are seeing two driving forces behind the deflationary trend of China. The first one is pretty obvious. It's because of the overcapacity, because of oversupply of housing, because of the unemployment and the surplus labor in the urban area. And I call this cyclical force behind the deflationary trend, and that's pretty obvious. And that's also leads to government measures trying to cut the capacity. And so this is a cyclical reason for the deflationary trend. The other reason I'm seeing is more structural reason for China to have a downward pressure on product price because of the tech and innovation. The cost efficiency of Chinese factories is getting higher and higher. It's becoming more efficient than before. And the Chinese factories has invested a lot in the past few years in improving their technology, in reducing costs, and to compete with each other in the market. And that's result in a cost reduction and making China more cost competitive. And I would think this is a structural reason for the deflationary trend that at the international level, we see the Chinese products become cheaper and cheaper and become more affordable. And I believe that this structural reason has not been fully appreciated or acknowledged in the markets, because a lot of people just focus on the cyclical reason without knowing that this China is so different from the previous China a couple of years ago.
Yeah, so that's a good way to talk about price deflation. That's good price deflation, if you like, improved efficiency, improved productivity. But there's another reason for the deflation, the investment share of the economy in China, 40%, about 10 percentage points higher than the rest of the world. What can China do to curb this overcapacity?
Exactly. The Chinese investment share to the GDP is a lot higher than average emerging economies, which is typically roughly between 30 to 35%. But for China, it's already more than 40% of the GDP related to investment. Worst of all is that all these investments are going to improve the efficiency and lift up their technology and total factor productivity. That's result in further downward pressure on product price, but still maintaining the product quality or even improving the product quality. So this is a phenomenon that we see that is perhaps a ongoing trend for China to continue to emphasize more on the tech and innovation related investment. And so I think that in the 15 5-year plan, which is the blueprint for the government to develop the country in 2026 to 30, which means that over the next few years, I don't see any change in the government policy to shift away from this policy tone. So total factor productivity improvement will still be a policy target, which means that the price pressure and the cost competitiveness of Chinese goods and services will continue to be stronger and intensified.
So many businesses, particularly large ones, seem quite relaxed or keen on looking to cut their costs right to the bone and cut their prices to the bone, if only to win market share and outcompete small to medium businesses. In China, this is sometimes called the involution, sort of race to the bottom price cutting. What's the government doing about this, or what should it do about it?
This anti-involution campaign is probably the top priority now, because the government see this as also contribute to this deflationary trend. And the large firms are able to cut costs, able to outcompete small and medium business by lower the price because of the scale of their business. And in fact, China is a very competitive economy, even though, on surface it's supposed to be a socialist country, but domestically it is basically running a perfect competition in terms of the economic institutions. So all businesses are able to compete with each other. For large firms, of course, they can make use of their scale in order to reduce the cost, in order to earn some market share. And now the government see this as perhaps a big problem.
Raymond Yeung there. Tomorrow, Raymond will run through what China's government could do to ease that effect of involution or deflationary competition. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, September the 24th. Catch you tomorrow with what today's Australian CPI data could mean for the RBA's stance on rate cuts. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.